and I appreciate you joining me for today's year-end update presentation. So I want to start off by saying that this has been an incredibly challenging year, and we're going to talk about some of this, but I think that we all need to recognize how much change we're all dealing with in our lives, not just business-wise, but I just think across the wide spectrum of our daily lives, we're just experiencing so much change. And some of that is good, some of that provides opportunities, but it could also be a little stressful. So today's agenda is to do a brief economic update, and then I want to finish with talking about some proactive tax planning ideas as 2021 winds down. So typically when I do these type of webinars, I use this slide because it highlights the 5 key areas of financial planning. I'm a certified financial planner. I adhere to these. Number 1 is preservation planning, 2, retirement planning, 3, tax planning, 4, estate planning, and then number 5, investment planning. And during the presentation today, we're not going to cover all of these necessarily, but I want to reinforce to all of you that when my team and I are working on clients' plans, when we think about our business, we don't just consider one of these key areas, but we want to consider all of the key areas. Even though we're not going to talk about all of them today, I did want to mention that. So I want to jump right in economically, talk about some causes for optimism. And I want to start with the tremendous faith that I see that people have in the stock market. The reality is that the stock market has done well for a long time. Coming out of the Great Recession back in 2008 into early 2009, the stock market was in a bull market period up until the pandemic arrived last year, and we had a sharp, powerful downturn last March. But it was very temporary, and the market bounced back quite strongly after that, and a new bull market has taken place. But if you back out that short, powerful downturn, the market has done well for a long time. And what I'm seeing, and I've been in the business 29 plus years now, is more faith in the stock market than I've ever seen before. People just have a tremendous amount of confidence in the ability of the stock market to generate returns over time, which history demonstrates is probably true. But we have a lot of young people that are entering into the stock market. We have a lot of older individuals that have amassed quite a bit of money in 401ks, the likes that we have not seen before because previous generations simply didn't have as much money in 401ks and didn't have as much money in the stock market. There's a lot of faith in the stock market, and that's a cause for optimism, and at least partially explains, at least a little bit explains, why the market is doing so well. People believe in the stock market. Now, in addition to being a financial geek, many of you, I'm looking at the list of attendees, know me pretty well. I'm also a history geek. And I know that there are times in history when people's faith in the stock market is jarred and they lose faith in the stock market. And sometimes that could last for quite a while. Sometimes it's temporary. But as I see it right now, something significant would have to happen to shake people's faith out of the stock market. Will it happen eventually? Yes, but so far, so good. The next cause for optimism is that the Federal Reserve is still accommodative. The Federal Reserve still wants to provide liquidity and help to the economy. It still has sort of an emergency footing where it's providing a lot of liquidity, and this is something that you don't necessarily see. The media generally doesn't necessarily talk about it. This is stuff that happens, let's just say, kind of behind the curtain. But the Federal Reserve is still accommodative. And there's an old adage that I still think holds true today, and that is don't fight the Fed. And the Fed is providing liquidity. It wants the markets and the economy to do well. It does not want to put the brakes on anything, at least not yet. And that is cause for optimism that the Federal Reserve is helping keep the wind behind the sails. The next bullet point I talked about at the mid-year economic update, and many of you attended that also. The government and the Federal Reserve has put a lot of money into the hands of Americans. There's just a lot of money sloshing around in the economy today, just a lot of money in circulation. Probably around 40% of the money that's in circulation today in the United States was created in the last year and a half. That's a lot of money that's been pumped into the system. And that money needs to find places to go. Some of it's ending up in real estate. Some of it's ending up being spent in a variety of different ways, which we'll talk about. But some of it's going into the stock market. There's another term that I've used with many of you, the TINA effect, T-I-N-A. It stands for there is no alternative. And the reality is we're essentially in a 0% interest rate environment. And when you keep money in the bank, or when you buy U.S. Treasuries as an example, and I have a slide that talks about Treasuries in a little bit, is you get very, very little interest, close to zero, historically low. And the TINA effect, there is no alternative, is that people are putting money in the stock market, not just because they have faith in it, but in many instances, there's not much competition. If you want to try and earn a good return on your money, a lot of people, rightly or wrongly, feel as though the stock market is an appropriate place. I think it is, by the way. It could be overdone. People are too aggressive or are not mindful of risk. But the reality is that the government and the Federal Reserve putting all this money in the system so far has helped the economy and helped the markets. I know some of you are thinking, well, what will happen next? What will be the next shoe to drop? I think that's an open question. But right now, today, and it's been like this for a while, I still put it in the cause for optimism category. The economic growth thesis is still intact. Even when the pandemic was raging at its heights last spring and early summer, what took hold was this thought that the U.S. economy would come out of this very strong, and we would have powerful economic growth, and that the economic growth cycle would last a long time. That is still intact. Now, we had in Q3 disappointing GDP growth for the quarter, less than expected. But despite that, most people think that the economic growth thesis is still intact. The idea that the U.S. economy is going to continue to grow, it's going to be pretty strong, and it's going to be with us a while. That is very optimistic. And that's been buoyed by strong corporate earnings. U.S. corporate earnings have rebounded very fast compared to the downturn last year due to the pandemic. It's bounced back remarkably strong. It is really a credit to the U.S. economy and U.S. businesses that are by and large well-led and well-managed, that you have strong corporate earnings. One other element of this is the recognition that this upheaval over the last year and a half has benefited large, big, publicly traded companies, probably at the expense in some instances of small, Main Street type businesses. So we're seeing strong corporate earnings. And as one of my favorite economists, Larry Kudlow, is fond of saying, is corporate earnings are the mother's milk of the stock market. That's ultimately what will benefit the market over the long term. So we see strong corporate earnings. We also see an energetic consumer. In the previous presentation, mid-year, I talked about how pent-up demand was getting unleashed. that people either couldn't or wouldn't do certain things because of the pandemic and the COVID risks. What we're seeing is that pent-up demand is coming online more and more as the days wind on and people either learn to live with the risks or feel like the risks are behind them. And this is doing wonders for the economy. The consumer is out there in a big way. And you know what? If you drive around, you probably could recognize this anecdotally. It seems like traffic is as big a problem as it ever was, where a year ago, I didn't feel it was like that. If you go to the airport, a lot of people are traveling. You're just seeing a very energetic consumer that's out there spending money, and again, that's doing wonders for the economy. And then I think another cause for optimism, and this I'm going to draw on my chops as sort of a history buff, is we are seeing an incredible amount of change in our lives across a wide spectrum. I said this at the outset. So much has changed, continues to change, and it's not just in one area, it's seemingly in most areas of our lives. But history tells us this country, which is very dynamic, the best, biggest economy in the world, in my opinion, you're seeing change, and if you go back to other historical instances, this change leads to good economic results. So I'm in the camp that this change, although will be uneven, might be stressful, might be a little chaotic at times, unnerving, pick your adjective. I think generally speaking, this rapid pace of change will ultimately be beneficial. And perhaps I am too optimistic and have too much faith, but that's definitely how I feel most of the time. So let me talk about the other side of the coin. There is so much going on, this change I spoke about and other factors, that there are a pretty good roster of things that we could be either slightly worried about to completely freaked out about. Now, I'm not freaked out about any of these things, but I know many people that I speak about can be at this point in time very, very worried. Inflation is probably top of mind for most people. I started talking about the inflation worry back in April. I did a podcast on the Simply Financial podcast show on it, and it made its way into a lot of client review meetings. And I think we were a little early to the story, but it has played out in a very impactful way to the point now, if you go and get coffee, people sitting around the bar or the island at your home, kitchen islands, if you can picture, people are talking about inflation. It is in the public discourse realm in a very big way right now. It's a significant worry. We're seeing inflation to the degree that you'd probably have to go back maybe all the way to the 1980s to find the last comparable period where inflation was similar to what we're experiencing now, certainly more than 10 years. And this is something I want to say is interesting because a lot of stuff that gets talked about by financial people is a little conceptual. It might be hard for people to picture if it's not really an area of interest for them, you know, like tax policy and capital gains rates. And there's a lot of things that might be challenging for some people to kind of appreciate. The inflation story is very real. It's very demonstrable. You know, you leave your house, you go fill up the gas tank, you see that gas costs way more than it did at the beginning of this year. You go to the grocery store, you see the cost of food is sky high. You go and meet some friends at a restaurant for maybe some food, have a meal with them, and you see how expensive the restaurant's prices are. You get your bill at home and you see your utility costs, and you're going to see this over the winter for those of us like me who are in a winter climate coming up. All heating bills are going to be up 30, 40, 50%. So inflation's a real worry. It's unclear what's going to happen. I think the jury is very much out. I will say that the administration and the Federal Reserve are, in my opinion, behind the curve. Janet Yellen, the Secretary of the Treasury under President Biden, for most of the year was forecasting inflation would run around 2%. Well, it's over 6%. It's 3 times higher than they anticipated. So they got it wrong, and maybe they could be criticized for that. But the point is, when you're that wrong, you're behind the curve. You have to adjust on the fly for the reality that's quite a bit different than the one you thought you would be dealing with. The Federal Reserve and the administration earlier this year was talking about inflation being transitory, which is a fancy word for temporary or short term. Well, they're not using that terminology anymore because it doesn't look like it's going to be transitory. And beyond that, it seems like Americans believe that it's not going to be transitory. Even people that don't normally pay attention to this stuff, when asked their opinion, seem to think that inflation is going to be with us for a while and are increasingly worried about it. And that becomes a self-fulfilling prophecy, perhaps. So inflation is a significant worry. There's a lot of factors for it, one of which is labor. We have a tremendous amount of strain in the labor force. As an example, I saw a statistic that we are short 80,000 truck drivers in this country. And I think that you can appreciate that you don't just snap your fingers and all of a sudden have 80,000 new truck drivers. This is going to take a little time to get the supply-demand imbalance between the need for truckers and available truckers or willing truck drivers to enter into the workforce. It's going to take a little time. But it's not just truck drivers. You see it all across the spectrum. I have a client, I don't see if they're on the call or not, but he's a recruiter for the tech industry. There's a shortage of high-end tech people in many sectors of the technology industry. Go into any restaurant and you could probably get a job as a waiter, waitress, hostess, cook. Probably don't even need any experience. The trades, welders, plumbers, electricians, construction workers, shortages there. There's just a lot of shortages in a lot of industries. It's very puzzling. It's not clear exactly what's happening. It really is not. Another element of this is that we have something that's been coined the Great Resignation. The last 2 months, we've seen a massive amount of people leave their jobs, 15 to 20% probably. And again, it's not clear what's going on. I think it's related to change. It might be due somewhat to government policy. It might be people viewing their work-life balance differently in the aftermath of the pandemic. I don't know. There's a lot to it. But what we do know is that it's worrisome that businesses are having trouble finding workers so that they can meet customer demand. That has to get resolved, and it will get resolved. It's just going to take a little time. I always point out next that there are always public policy risks. I already mentioned before that I've been in the business 29 years, and it's important to note that the world we live in today, much of it starts from what our politicians do in Washington, D.C. There's no way around it. It affects business, the markets, the economy, our personal lives, healthcare, and so it's important that our politicians make more good decisions than bad decisions. It counts an awful lot today. There was a time in this country where our political climate, the power that Washington wielded, was more laissez-faire, which is hands-off. But we don't live in that country right now. Maybe we should, and we could debate that. I'm not speaking to what it should or shouldn't be, but the reality is when Washington passes bills into law, like recently the infrastructure bill, it's thousands of pages long, and it is very impactful in a wide area of the economy. And so I think, and I talked about this at the previous webinar also, is that it seems to me one of the risks is that the government in some ways is behaving like we're still in an emergency, like we were last year. But I don't feel like we're in an emergency. I feel like we're in a delicate time. I know there's a lot of change, a lot of things that need to get addressed. But this emergency footing might lead to bad results, and I worry about that from a public policy standpoint. And it's not just me. If you look at wrong track, right track polling right now in this country, I think it's something like 72%, don't quote me on that, but I should be close. Americans believe the country's on the wrong track. Now, to get to 70+% on right track, wrong track, that means it's not just Republicans that are unhappy with President Biden. That means there has to be a decent amount of independents and Democrats to be able to get that number. And there's lots of other instances where it seems like the public in the United States is not happy with what's going on. Some of it's driven by political party, but not all of it. I think, in my opinion, President Biden has had a tough go of it in the first 10 months or so of his presidency, and a lot of people are questioning whether he is taking us in the right direction or not. A lot has to be played out. He's only 10 months into a 4-year term. We have midterm elections next year. A lot can change. But public policy risks are, I think, a reason to worry. This idea that the government is operating like we're in an emergency, where it doesn't feel like we're in an emergency anymore. I already touched on this. Federal Reserve policy is likely to change. And it's been the same for quite a while. And when the Federal Reserve changes its policy, sometimes there can be some disruptions. The Federal Reserve often is a cause of recessions and market corrections. They are in the Federal Reserve a difficult position, I think. There's no easy answers, and almost any choice they make seems to be fraught with potential downsides. So they're really going to have to thread the needle. So it's a little worrisome that the Federal Reserve is probably on the verge of changing their policy, and they're going to have to really strike the right notes to be able to pull this off seamlessly. People generally have confidence in the Federal Reserve right now. We'll have to see how they can handle the challenges that are in front of them. Of course, this recovery that I talked about, this economic growth thesis that I said is intact, it could still be derailed by any number of reasons, including the 4 previous bullet points. You throw in geopolitical events. There's some unrest in Poland and Belarus and in Ukraine. You have China flexing its muscles. Middle East is always a potential hotspot. There's any number of things that could, in the world, derail this recovery. It's definitely taken hold. The thesis is still intact, but it can be derailed. Rapid pace of change. This may sound familiar because I used that term on the previous slide. This rapid pace of change, even though I think in the long term is cause for optimism, it creates a lot of challenges for all of us, individually, businesses, governments, policymakers. And the reality is that there's going to be winners and losers probably. And this change, unfortunately, doesn't happen smoothly. And it seems like this country is very divided. I think we could mostly agree on that. That's probably not healthy long-term for the country, but even more specifically for the economy and for the markets. We'll have to see how this plays out. Again, this change, I think, long-term, I am an optimist about the country. But this pace of change, it's tough to adjust. You know, you just think about how much has changed over the last 18 months. It's breathtaking, and we're probably not done. And when you have change this fast, it can be chaotic and problematic and all the other adjectives I've used. So I think it's both a reason to be optimistic and a reason to be worried at times. Before switching to some tax policy stuff, I want to talk a little bit about more about inflation and interest rates. I've mentioned the Federal Reserve a couple of times. More specifically, they met in September and they decided to keep interest rates unchanged. Not surprising. But they continue to hint more strongly than before that when they start to see enough change in unemployment or employment numbers and inflation numbers, that they're likely to change their policy, meaning raise interest rates. They've begun to taper this month, so let's just talk about that term. So I referred earlier to the Federal Reserve as providing liquidity to the system. They are, beginning this month, going to taper off that liquidity activity that they're doing. And they're going to taper that off. They're not going to stop all at once. They're going to taper it off, and they expect to finish around the middle of 2022. So if you think about that, I believe, and I'm not alone in this, I believe that the Federal Reserve is not likely to raise interest rates while they are still tapering. Because before they're done tapering, that means they're putting money into the system, providing liquidity for the system. Well, it makes no sense to be doing that on one hand and raising interest rates on the other hand. So they probably will not raise interest rates until they're done tapering. So my best guess is that the earliest we would see interest rates go up is the middle of next year. Now, this is very fluid, because the inflation story is gaining traction, and the inflation numbers are stronger than expected. I already explained about Janet Yellen and the administration being behind the curve, thinking it was going to be 2, and it's +6. So this opinion that I'm giving could change. It might have to change. We have to see how it plays out. The 10-year Treasury, which is kind of the benchmark, finished the third quarter at 1.52%. It was as high as 2.45 back in March, so it has come down some. This slide is meant to display to you that we are still in a very low interest rate environment, historically low. And you know this. If you look at what your bank account is earning, it's probably earning 0.2% or less, maybe as much as 0.5%, but awfully close to zero. So key takeaways, and then again we'll get into some tax concepts, is I think caution is still the principal notion for investors. The market is at or near highs. It's had a great run, but there's so much going on, that being a little cautious, given some of the worrisome, challenging things this country has to contend with, makes sense to me. Interest rates are near zero, but they're likely to rise sooner than expected, especially based on what the Federal Reserve had forecasted as early as Q1, Q2 of this year. The inflation worries, they become much more prevalent. We've been talking about it since April, but now this topic is everywhere and is now, I think, a chief worry amongst most Americans, and I think it's a fair worry. And then I already said the Fed is going to start tapering this month, and that's notable. You're not going to see this or notice this in your daily lives, but it's happening behind the scenes, and it's the first sign that the Fed is not just going to talk about changing their tactics, but actually changing. So tax planning. Usually when I begin to talk about tax planning, I use one of my favorite quotes from Benjamin Franklin: "By failing to prepare, you are preparing to fail." And I think with tax planning, it's important because remember, when you go and prepare your taxes in 2022, you're actually doing it for 2021. You can't do much because you're in the new year. It's too late. And what we want to do is, I think I skipped a slide. I hit the keyboard too many times. Is what we want to do is be proactive in tax planning and not reactive. Waiting until you prepare your taxes is reactive and in many instances too late. We want to be proactive. To be clear, we do not here at Elliott Wealth Management prepare taxes. I'm not a CPA. I'm not an accountant. We do not prepare taxes. But when we are planning with clients and we're thinking through our business objectives, we want to work with our clients to mitigate taxes smartly, to mitigate taxes wherever and whenever possible by proactive, smart planning. So let's talk about some of the fundamentals of taxes right now. Here are the tax brackets. I think that based on history, where we are now, tax rates are historically low. In fact, President Biden would like to raise these rates at the very least, for high-income earners. By the way, I do not think that the Biden administration, despite their desire to do so, will be able to get past significant tax legislation, and you could read that as tax increases. I don't think it's going to happen this year. I don't think it's likely to happen next year because you start to get into the mid-year election cycle in very short order. I just think that how things played out this year with their legislative priorities and also being overtaken by other things like the pandemic, the Delta variant, Afghanistan, other stuff I probably am failing to mention. I just don't think they were able to get to it. They just got the infrastructure bill passed. That was bipartisan, especially in the Senate. A number of Republicans in the House joined the Democrats to pass it recently. The focus is now on trying to get the Build Back Better legislation passed. It remains to be seen whether that'll happen, but they're using their time and energy to get that passed. I don't think there'll be enough time and energy to do the tax legislation like they originally envisioned. But back to the tax rates. I think these are historically low rates. It's not just that the rates are low, it's that the brackets are larger. So you stay at those lower rates at higher income levels than you did before. So the lowest rate's 10, the highest is 37. If we do not get legislation through Congress signed into law by a president, these rates are set to phase out in 2026. So they'll be with us maybe for a while longer. Standard deduction amounts for married filing jointly, it's $25,000. This was a key part of the tax reduction that President Trump was able to get passed. It kind of simplified things. 80 to 90% of Americans use the standard deduction. They don't itemize. Capital gains rate, if you're married filing jointly, you have a 0% capital gains tax rate up to the first $80,000 of income. You are in 15%, which is going to be most of us most of the time if your income, again, married filing jointly. If you're between $80,000 and $500,000, and it's 20% over $500,000. So I want to talk a little bit about harvesting capital losses and gains, and you could get really into the weeds in this. I just want to talk about it from pretty high level, is that if you sell something and you have a gain, and you sell something and you have a loss, you could offset one another so that you could perhaps avoid taxes and perhaps enable yourself to use your tax loss instead of carrying it forward. So at the end of the year, sometimes you want to sell certain things because they have a loss. They may not be working. And you want to be able to also sell something as a gain and have them maybe cancel each other out. So this is something that we work on. and we look at, and is applicable for non-retirement accounts. This is not workable inside any tax-qualified account. Annuities, variable annuities, IRAs, 401ks, pensions. This is for money outside of retirement accounts. One note, and I mention this just because there's so much confusion out there. So if you sell something for a loss, you can't immediately buy back that security or something substantially similar for 30 days. The government's not going to let you take the loss on your taxes, reduce your taxes by recognizing that loss, only to just buy the same thing or something very similar right away. You have to wait 30 days. Make sense? Hopefully I explained that well. Where the confusion comes in is that people think that that applies when you sell something creating a gain. There is no wash sale rule. There is no 30-day issue when you sell something for a gain. You could sell something for a gain, maybe have that gain be sopped up because you have a loss, and you could buy back that security the next day if you wanted to. Don't have to wait the 30 days. So what we'll do is we'll be looking for opportunities to harvest capital gains and losses here as the year continues to wind down. Another terrific proactive tax planning technique is Roth IRA conversions, because if you're in a year where your tax bracket is low, maybe temporarily low, you might want to consider converting to a Roth IRA. If your tax bracket's lower now compared to where you think you'll be in the future, that is a strong indication that you want to consider doing Roth IRA conversions. So real quickly, when you convert, you're taking money from a pre-tax account like a IRA where the money in there has never been taxed. You could take some of that money out of that traditional IRA, convert it to a Roth IRA. A key element of that, though, is that you'll pay taxes. So if you convert $10,000 from your pre-tax IRA to your Roth IRA, you'll pick that $10,000 up as ordinary income. It'll be subject to income taxes. But then when it goes in the Roth IRA, it will probably be tax-free for the remainder of your life, and you probably could pass it on to the next generation tax-free as well. So it's pretty powerful, the Roth IRA. The Roth IRA has become increasingly popular. We're using it more in the practice. I use it more in my personal wealth building activity, plan I should say. And what you find is when you look at the amount of money that are in Roth accounts, it is growing by leaps and bounds because people are embracing the benefits of Roth IRAs in a way, in a much more substantial way than we used to. Also note quickly that Roth IRAs are not subject to RMDs. So that's required minimum distributions. Generally for retirement accounts, you have to begin taking money out at age 72. That does not apply to Roth accounts. And a lot of people like that feature an awful lot. So here, and this is a good reference slide for all of you, is year-end tax summary checklist. You want to manage your tax brackets. You know, if you're in low tax bracket, 10 or 12%, for example, you might want to consider converting and filling up that 12% tax bracket. Gain loss harvesting I talked about. There are tax-advantaged strategies around education planning and 529 plans. Around charitable planning, there's something called qualified charitable distributions if you're 70 and a half or older. There's estate planning opportunities. There's a lot of things that you could think about during the course of the year working with me and the team here at Elliott, along with your accountants, to make sure that you are not paying taxes needlessly, not just today, but looking into the future to manage your tax situation on an ongoing basis. So what we want to do for all of you is keep track of all the changes that are going on, tax-wise, markets, economy, legislation. As I've said numerous times, there's a lot going on. But we want to communicate with you. Check out my podcast if you haven't done so. It's a key way that I share my thoughts with all of you. We're going to have frequent discussions. Reach out to us if you have questions. If anything changes on your end, change in marital status, in inheritance, job status, significant increase or decrease in income, change in your outlook on risk, you become more worried, more optimistic, what have you, please keep the lines of communication open. Check in with us. That's what we're here for. So we're going to continue to review all of this stuff, the economy, taxes, estate, investment issues, do the best we can. We would like to grow the practice. So if you know of anyone that would be open to a discussion with us, they might, through this whole pandemic episode, might be a little concerned about one or more things. They might be looking for a second opinion or a fresh perspective. So please keep us in mind. And as we kind of wrap up, please know, and I say this often, that your health, your well-being is our highest priority. I always, always appreciate the opportunity to work with you, to help you with your financial needs. Our motto is we're always planning for your success together. So thank you for the business, the confidence you have in us, and I look forward to speaking with you all very soon. I can open up to some questions here if you want. I know I've gone about 45 minutes, which is right on target. So maybe we could just leave it there if that's okay with everybody. But please know, if you have any questions about any of this or you need more information, you want to discuss how one or more of the things discussed affect you individually and we haven't covered it already, shoot me an email, call the office. You could sign up right on our website, elliottwealth.com. Right there, you could access my calendar and reserve a meeting time slot, and you can specify whether you want it to be a call, whether you want it to be via Zoom, or if you want it to be in person, so it's very flexible. Take advantage of that. Again, I want to thank everybody for joining me today. I appreciate the time and the confidence you have in me, and I hope you all have a wonderful, wonderful holiday season. Thanks again.